$277 trillion debt bomb is ticking. And when it explodes, it'll make 2008 look like a minor hiccup. But here's the thing. While financial media keeps telling you everything's fine, top analysts are quietly sounding the alarm about something much worse than a recession. We're talking about a complete restructuring of the global financial system. What you need to understand is that this isn't another doom and gloom prediction. This is mathematical certainty backed by data that Wall Street desperately doesn't want you to see. If you want to know how to protect your wealth before this debt tsunami hits, smash that like button and subscribe to Finsight Capital. Because what I'm about to reveal will completely change how you think about investing. Let me paint you a picture of where we are right now. It's March 2025. You're scrolling through your investment portfolio, maybe checking your 401k, feeling pretty good about the market highs. Everything looks stable, right? Wrong. Behind the scenes, something unprecedented is happening. Global debt has reached levels that would make previous generations question our collective sanity. We're not just talking about government debt anymore, though that's terrifying enough. We're talking about a perfect storm of corporate debt, consumer debt, and government obligations that's creating the most dangerous financial environment in human history. Here's what's really happening while everyone's distracted by the latest market rally. That red line you're seeing? That's global debt shooting up like a rocket. In 1980, total global debt was around $40 trillion. Today, we've hit $277 trillion. That's not a typo. $277 trillion. To put that in perspective, if you spent $1 million every single day since Jesus Christ was born, you still wouldn't have spent $1 trillion. And we're talking about 277 times that amount. But wait until you see who's holding the biggest piece of this debt bomb and why their upcoming decision could trigger the largest wealth transfer in modern history. I'll reveal that shocking truth in just a moment. But first, you need to understand how we got into this mess. The story begins in 2008. Remember the financial crisis? The one that was supposed to teach us all about responsible lending and the dangers of too much debt. Well, here's the twisted irony. Instead of learning from our mistakes, we doubled down. Actually, we quadrupled down. Central banks around the world unleashed the most aggressive monetary experiment in history. They slashed interest rates to zero, then went negative. They printed money like it was going out of style. The Federal Reserve alone created over $4 trillion out of thin air. The message was clear. Debt doesn't matter anymore. In 2008, when the world nearly ended financially, global debt was $142 trillion. We thought that was unsustainable. Today, we're sitting at $277 trillion, nearly double what caused the last crisis. But here's what's truly terrifying. The quality of this debt is worse than anything we saw in 2008. Much worse. Back then, we had a housing bubble fueled by subprime mortgages. Today, we have everything bubbles fueled by something far more dangerous. Zombie economics. Let me explain what I mean by zombie economics, because this is where things get really scary. A zombie company is one that can't make enough profit to cover its debt payments. It only survives because interest rates are so low that banks keep refinancing its debt, hoping things will improve. In a healthy economy, these companies would fail, freeing up resources for productive businesses. It's creative destruction. Painful, but necessary. But we haven't had creative destruction in over a decade. Instead, we've kept zombie companies alive with cheap money. Here's the shocking data. In the United States, nearly 20% of publicly traded companies are now zombies. In Europe, it's even worse, over 25%. In Japan, where this experiment started, it's approaching 30%. These aren't small companies we're talking about. Major corporations that employ millions of people are essentially dead, but don't know it yet. Take WeWork. Remember them? At one point, they were valued at $47 billion, so they burned through cash faster than a rocket ship burns fuel. Their business model made no sense. Any rational analysis would have killed this company in its infancy. But cheap money kept it alive for years. Investors kept pouring billions into a company that was fundamentally broken because money was free and they had to put it somewhere. WeWork eventually collapsed, but not before destroying billions in investor wealth and creating a template that thousands of other zombie companies are following today. Now imagine WeWork, but instead of one company, it's thousands of them. Instead of 47 billion, it's trillions of dollars. Instead of just venture capitalists losing money, it's pension funds, insurance companies, and your retirement account. That's exactly what we're facing right now. Let me break down this $277 trillion debt bomb into categories so you can see where the real danger lies. First, we have government debt. This is the most visible part of the crisis. The United States government owes $33 trillion. That's $100,000 for every American citizen, including babies. Japan owes 260% of their entire economic output. Italy, Greece, and several other European countries are technically bankrupt. They just haven't admitted it yet. But government debt is actually the least of our problems, because governments can print money. They can inflate their way out of debt, destroying savers in the process, but they can do it. The real danger is corporate debt. Global corporate debt has exploded from $56 trillion in 2009 to over $94 trillion today. That's a 68% increase in just 15 years. But here's what's truly terrifying. Most of this debt was issued when interest rates were near zero. Companies got used to borrowing money for practically nothing. Now interest rates are rising, and these companies are facing a refinancing cliff. Over the next 3 years, $9 trillion in corporate debt needs to be refinanced. Companies that borrowed money at 2% interest will now have to refinance at 7% or 8%. For healthy companies, this is challenging but manageable. For zombie companies, and remember, that's 20% to 30% of all companies, this is a death sentence. But there's something even scarier than corporate debt, and it's hiding in plain sight: consumer debt. This is where ordinary people like you and me get destroyed. The average American household now owes $6,270 in credit card debt at an average interest rate of 21%. That's the highest level ever recorded. Auto loans have hit $1.6 trillion, so the average car payment is now $738 per month. People are financing cars for 7, 8, even 9 years. Student loans have reached $1.7 trillion. The average graduate owes $37,000, and many owe much more. But the real killer is mortgage debt. The median home price in America is now $417,000. The median household income is $70,000. That means the average house costs 6 times the average salary. Historically, that ratio has been 3.5 to 1. We're in bubble territory that makes 2006 look reasonable. Young people can't afford to buy homes. They're trapped in a rental market where prices are rising faster than wages. They're forced to take on more debt just to survive. But here's where this gets personal for every single person watching this video. All of this debt was sustainable as long as interest rates stayed low and economic growth continued. But something changed in 2022 that broke the entire system. Central banks started raising interest rates aggressively to fight inflation. The era of free money ended overnight. Suddenly, all that debt became expensive to service. Companies that had been surviving on cheap credit faced bankruptcy. Consumers who had maxed out credit cards at 0% interest now faced 25% rates. The system started breaking down piece by piece. Silicon Valley Bank collapsed in 48 hours. Credit Suisse, a 167-year-old institution, disappeared overnight. Regional banks across America started showing signs of stress. Why? Because they had made the same bet everyone else did, that interest rates would stay low forever. When rates rose, their bond portfolios collapsed. When nervous depositors started withdrawing money, these banks faced a liquidity crisis. But bank failures are just the appetizer. The main course is coming, and it's being served by an institution that most people have never heard of, but controls more wealth than most countries. I'm talking about BlackRock, and what they're planning will shock you. BlackRock manages over $10 trillion in assets. That's more than the GDP of every country except the United States and China. They're the largest shareholder in virtually every major corporation. When BlackRock speaks, markets listen. When they make a move, trillions of dollars follow. And right now, BlackRock is quietly preparing for something they're calling the Great Reset of Finance. According to internal BlackRock research that was leaked to financial insiders, they're preparing for a scenario where 30% to 40% of current corporate debt becomes worthless. They're positioning their funds to benefit from the largest wave of corporate bankruptcies in history. They're buying distressed debt at pennies on the dollar, planning to own entire industries when the smoke clears. This isn't conspiracy theory. This is business strategy. BlackRock sees the debt crisis coming, and they're positioning to profit from it. But BlackRock's strategy reveals something terrifying about the timeline we're facing. According to top analysts who work with BlackRock, the debt crisis will unfold in 3 distinct phases. Phase 1 is already happening. We're seeing zombie companies fail one by one. Small businesses that survived COVID are now dying from high interest rates and inflation. Commercial real estate is collapsing. Office buildings in major cities are worth 50% less than they were 2 years ago. The owners of these buildings borrowed against inflated valuations, and now they can't refinance their debt. Phase 2 begins when major corporations start failing in clusters. This is expected to happen in the next 12 to 18 months as the refinancing cliff hits. But Phase 3 is the big one. Phase 3 is when the sovereign debt crisis hits. That's when governments can no longer service their debt, even with printed money. Most analysts think this is years away. But there's one country where it's already starting, and when it falls, it'll create a domino effect that destroys the global financial system. I'm talking about China. China's total debt to GDP ratio has exploded from 150% in 2008 to over 300% today. They've built an entire economy on debt-fueled infrastructure projects that generate no economic return. Ghost cities, bridges to nowhere, high-speed rail lines with no passengers. China has borrowed trillions to build things nobody needs. Their real estate sector, which represents 30% of their economy, is collapsing. Major developers like Evergrande and Country Garden have defaulted on hundreds of billions in debt. Here's a number that should terrify every investor. China's total debt is now 50 trillion yuans. That's more than the GDP of the United States and European Union combined. When China's debt bubble pops, and it will pop, it'll create a deflationary shock that will be felt worldwide. Chinese companies owe money to banks around the world. Chinese consumers buy products from companies around the world. Chinese demand has driven commodity prices for decades. When China's economy contracts, and it's already happening, it creates a deflationary spiral that makes everyone's debt more expensive in real terms. Countries that export to China see their revenues collapse. Commodity producers see prices fall. Companies that borrowed in dollars find their debt becoming more expensive as their local currencies weaken. This is how a debt crisis in one country becomes a global catastrophe. But here's what's really scary. The timeline for all of this is accelerating much faster than anyone expected. In just the past 3 months, we've seen Japanese bonds selling off as investors lose confidence in their ability to service debt. European banks reporting massive losses on commercial real estate loans. U.S. regional banks failing stress tests related to commercial real estate exposure. Chinese local governments unable to pay government employees. These aren't isolated incidents. They're symptoms of a system-wide breakdown that's happening in real time. This is why top analysts are sounding the alarm. People like Ray Dalio, who predicted the 2008 crisis. People like Michael Burry, who made billions betting against subprime mortgages. These aren't perma-bears who predict doom every year. These are investors with track records of being right when it matters most. Ray Dalio recently said, and I quote, "We are in the late stages of a long-term debt cycle that will require a significant restructuring of debt and wealth. This will be more severe than 2008 because the debt levels are much higher and central banks have less ammunition." Michael Burry tweeted, "The everything bubble is deflating. When it pops completely, the magnitude will be biblical." These aren't casual observations. These are warnings from people who see the data that most investors never see. So what does all of this mean for regular investors like you and me? First, understand that this debt crisis will create the greatest wealth transfer in modern history. Wealth will flow from debtors to creditors, from leveraged companies to cash-rich companies, from risky assets to safe assets. If you're positioned correctly, you can benefit from this transfer. If you're positioned incorrectly, you could lose everything. There are specific strategies that smart money is using right now to protect wealth and even profit from the coming crisis. But before I reveal those strategies, you need to understand the 3 biggest mistakes that will destroy most investors. Mistake number 1, believing that governments will bail everyone out like they did in 2008. The math has changed. In 2008, global debt was $142 trillion. Governments could issue new debt to fund bailouts because their own debt levels were manageable. Today, governments are already drowning in debt. They can't borrow more without triggering their own crisis. The bailout capacity that existed in 2008 simply doesn't exist today. The U.S. debt to GDP ratio has gone from 65% in 2008 to over 120% today. Japan is at 260%. Italy is at 150%. These countries are approaching the mathematical limits of their borrowing capacity. They can't save everyone because they can barely save themselves. Mistake number 2, thinking that inflation will continue to erode debt burdens. This is a dangerous misconception. Yes, inflation reduces the real value of debt over time. But it only works if your income rises with inflation. For most people, wages aren't keeping up with inflation. For most companies, revenues aren't keeping up with costs. Real wages have declined for 3 consecutive years. Small businesses are seeing profit margins compressed by rising costs they can't pass on to customers. Inflation isn't solving the debt problem. It's making it worse by destroying purchasing power faster than it reduces debt burdens. But here's what's really scary. We're not going to get sustained inflation. We're going to get deflation. When the debt bubble pops, it creates a deflationary spiral. Asset prices fall, companies cut costs, unemployment rises, demand collapses, and prices fall further. This is what happened in Japan for 30 years. This is what happened in the 1930s. And it's what's starting to happen now in China. Deflation makes debt more expensive in real terms. It destroys borrowers and rewards savers. Mistake number 3, believing that diversification will protect you. Traditional portfolio theory says you should diversify across asset classes: stocks, bonds, real estate, commodities. But in a systemic debt crisis, all leveraged assets fall together. Stocks fall because companies can't service their debt. Bonds fall because default risks rise. Real estate falls because buyers can't get financing. Commodities fall because industrial demand collapses. Look at what happened in 2008. Everything except US Treasuries and cash fell at the same time. Correlations went to 1, meaning diversification provided no protection. The same thing will happen in the next crisis, but worse, because debt levels are higher and central banks have less ammunition. So if traditional strategies won't work, what will? Smart money is implementing a 3-part strategy that I call the Crisis Capital Framework. The Crisis Capital Framework has 3 components: preservation, positioning, and profit. Let me break each one down for you. Part 1, preservation. This is about protecting what you already have. In a debt crisis, cash becomes king. Not because it generates returns, but because it preserves purchasing power and provides optionality. Smart investors are holding 30% to 50% of their portfolios in cash or cash equivalents. This sounds crazy in a world where cash pays nothing, but it makes perfect sense when everything else is about to fall. But not all cash is created equal. You want FDIC-insured accounts up to the limit, treasury bills with maturities under 6 months, money market funds that invest only in government securities. Avoid bank CDs beyond FDIC limits, corporate bonds, and anything with credit risk. Here's exactly what the smart money allocation looks like: 40% cash and cash equivalents, 20% precious metals, gold and silver, 20% productive assets with no debt, 20% opportunistic investments for the recovery. This isn't a get-rich-quick scheme. This is a preserve wealth and position for opportunity strategy. Part 2 is about positioning for the inevitable recovery. Every crisis creates opportunities, but only for those who have capital available when assets are cheap. The best assets to own during a debt crisis are productive assets with no debt. Think profitable companies with strong balance sheets, productive real estate owned free and clear, businesses that generate cash flow without leverage. Companies like Microsoft, Apple, and Berkshire Hathaway have massive cash reserves and little debt. They'll not only survive the crisis, they'll benefit from it by acquiring distressed competitors. Precious metals. Gold and silver have been money for 5,000 years. They can't be printed, debased, or defaulted on. When confidence in paper money breaks down, precious metals become the ultimate store of value. Essential commodities. Food, energy, and materials that people need regardless of economic conditions. But avoid commodity companies with high debt levels. Own the physical commodities or companies with fortress balance sheets. Here's the specific precious metals allocation smart money is using. 15% physical gold, coins and bars, 5% physical silver. Store it securely outside the banking system. Think of it as insurance, not investment. This isn't about getting rich from gold. This is about preserving purchasing power when paper currencies fail. Part 3 is about profiting from the crisis. This is the most aggressive part of the strategy and should only be attempted with money you can afford to lose. The biggest profits during a crisis come from distressed debt investing. When companies go bankrupt, their bonds often trade for pennies on the dollar. If you can identify which companies will survive, you can make enormous returns. Short selling overvalued assets, zombie companies, overpriced real estate, bubbled markets. These will all collapse, and you can profit from the decline. Vulture investing, buying productive assets from distressed sellers at fire sale prices. This is how fortunes are made during crises. During the Great Depression, investors who had cash and nerve could buy productive assets for 10 cents on the dollar. During the 2008 crisis, distressed real estate provided 30% annual returns for the next decade. The same opportunities will emerge from the coming debt crisis, but only for those who are prepared. But here's the critical point about timing. You have to implement this strategy before the crisis hits, not after. Once the crisis begins, it's too late. Asset prices fall faster than you can react. Credit markets freeze, liquidity disappears. The time to prepare is now, while markets are still functioning and assets can still be repositioned. Several factors suggest the timeline is accelerating faster than most people realize. Factor 1. The Federal Reserve's impossible position. The Fed faces an impossible choice. They can fight inflation by raising rates, but that triggers the debt crisis. They can lower rates to prevent the debt crisis, but that reignites inflation. They can't do both, and either choice leads to disaster. They're trapped by the mathematics of debt. Factor 2. The commercial real estate collapse. Commercial real estate is already in free fall. Office buildings are worth 50% less than 2 years ago. Regional banks that lent against these properties are facing massive losses. This is 2008's subprime crisis, but focused on commercial rather than residential real estate. Factor 3. International dollar funding stressed countries around the world borrowed trillions in US dollars. As the dollar strengthens and US interest rates rise, these countries face a funding crisis. This is how domestic US problems become global catastrophes. These factors are converging right now. The debt crisis isn't coming in some distant future. It's happening in slow motion today. Here's what I need you to understand. This debt crisis is not a prediction. It's a mathematical certainty. When you have $277 trillion in global debt, much of it borrowed at artificially low interest rates, and those rates rise significantly, the math becomes very simple. Many borrowers can't pay. When borrowers can't pay, lenders lose money. When lenders lose money, they stop lending. When lending stops, economic activity collapses. This creates a deflationary spiral that feeds on itself. Falling asset prices make debt burdens heavier. Heavier debt burdens force more asset sales. More asset sales drive prices lower. The only way this cycle breaks is when debt is destroyed through default or devaluation. Either way, wealth is redistributed on a massive scale. This has happened before. The 1930s, Japan in the 1990s, Argentina in 2001, Greece in 2010. Each time, the same pattern emerged. 1. Excessive debt accumulation during good times. 2. A triggering event that exposes the unsustainability. 3. A cascade of defaults and bankruptcies. 4. Massive wealth redistribution from debtors to creditors. 5. Eventually, a reset and recovery were currently between stages 2 and 3. The triggering event, rising interest rates, has already happened. The cascade is beginning. So what should you do right now? First, assess your own debt situation. If you have high-interest debt, pay it off immediately. If you have variable rate debt, lock in fixed rates while you still can. Second, build your cash reserves. Aim for 6-12 months of expenses in liquid, safe accounts. This isn't just emergency funds. This is opportunity capital for when assets go on sale. Third, reduce your exposure to leveraged investments. Avoid companies with high debt levels, regardless of how attractive they look today. Avoid real estate investment trusts, leveraged ETFs, and anything that amplifies risk. Fourth, Consider precious metals as insurance. Not speculation, insurance. Gold and silver have preserved wealth through every currency crisis in history. Fifth, identify the productive assets you want to own when they become cheap. Make a shopping list of quality companies, prime real estate, or businesses that you'll buy when they're available at distressed prices. The debt crisis will create winners and losers on an unprecedented scale. The question is, which side will you be on? Winners will be those who see this crisis coming and position themselves accordingly. Losers will be those who ignore the warning signs and get caught in the collapse. I've given you the framework. I've shown you the data. I've explained the timeline. Now it's up to you to take action. If this analysis opened your eyes to the reality of our debt situation, smash that like button and subscribe to Finsight Capital. We're building a community of investors who refuse to be blindsided by financial crises. Hit the notification bell so you don't miss our upcoming videos on specific investment strategies, asset protection techniques, and crisis profit opportunities. And here's something special for our subscribers. We're creating a private Discord community where we share real-time market analysis, specific stock picks for the crisis, and early warnings when conditions change. The link is in the description, but it's only available to subscribers who demonstrate they're serious about protecting their wealth. Before you go, let me leave you with one final thought that could save your financial life. The biggest mistake investors make during a crisis is trying to time the bottom. They wait for the perfect entry point and miss the entire opportunity. Instead of timing the market, focus on positioning yourself to benefit regardless of timing. Hold enough cash to survive any scenario. Own enough productive assets to benefit from recovery. Have enough precious metals to preserve wealth if paper money fails. This isn't about getting rich quick. This is about surviving and thriving through the greatest financial crisis of our lifetimes. In our next video, I'm going to reveal the specific companies that are positioned to not just survive, but dominate after the debt crisis. These are businesses with fortress balance sheets, essential products, and management teams that understand what's coming. Some of these companies are trading at reasonable valuations today, but will become extremely expensive when investors realize their true value during a crisis. The video goes live this Wednesday. Make sure you're subscribed with notifications on so you don't miss it. Remember, in crisis, there is opportunity, but only for those who are prepared. Thanks for watching Finsight Capital. I'll see you in the next video.